Hey everybody, this is Paul Perry with Alpha Insurance, and we're here today again to talk about insurance made simple. Get a lot of questions, and we're going to talk about one of the biggest questions I get, which is what all affects what I pay for insurance. We're going to focus on autos today, and we're going to talk about a few myths that are either true or false about how it affects your auto rate. Number one is color affects what I pay for insurance. And thankfully, the color of your car has no bearing whatsoever on the cost of insurance. So you can buy all your red Corvettes and whatever car you want, and that won't have a bearing. Now, what will have a bearing is what the cost to repair your car is. So the more expensive the parts are, the more labor intensive it is to repair your car, the more expensive it's going to be to insure your car. So also the next thing is how often is your car stolen? For whatever reason, thieves love certain cars to steal. Some of it's because they're just made more. If you got a car that's 20 of them were made, the chances of it being one of the top stolen cars is probably very small. But if there's 1 million of those cars, it's probably going to be the one that's going to be stolen. The last thing is going to be the safety rating for your car. So how safe, how well is it constructed, how well does it protect the occupants, and if it's got anti-lock brakes and it's got lane avoidance and it's got things like that, it's going to be a lower rate to be able to insure it because it protects you from getting in an accident. All right, number two, let's talk about the myth that it costs more to insure as you get older. Now, this one has some truth to it. It just depends on how old you are. So if you're in your teens and your early 20s, the chances of your insurance going down are very good once you hit age 25. That's that magic number when the insurance companies feel like, hey, you've become a quality citizen, you're less likely to take risks. And the next thing is when you get married. Again, you become typically more responsible. You got somebody else you're caring for. As you rock on to your 30s and 40s and 50s and 60s, it's probably pretty much going to stay pretty constant. But as you get into your 70s and 80s, it will get more expensive. You are at a higher risk of having an accident because a lot potentially or statistically, your reflexes may not be as good. Your decision-making processes are probably good, but it's just there's historical evidence to prove that 70s and 80s, people get in more accidents. So let's talk about number three. Credit has no effect on my rates, and that is false. Credit has a big effect on your rates, whether it's auto or home. Now, if you've got good credit, that means that you're going to get a better rate. Now, insurance companies get that through an insurance score, which not only looks at credit, but it looks at your claim history and your moving violations. They rank you based on all of that information. And luckily, it doesn't affect your credit rating in the sense that you could go to 20 car insurance places, and run rates, and it doesn't affect. It's not going to hurt your credit. But it will have an effect. The better credit you have, the better your rate's going to be. All right, number four, only my accidents will affect me and my rate. And that's not completely true either. Your accidents will affect your rate. But if your accidents and you have violations, moving violations, that will affect your rate. The company experience, if a company has a lot of claims because of the California fires and then a lot of claims because of the hurricanes that came in Louisiana, they got to pass along that expense somewhere. It wasn't necessarily anybody's fault, but it cost the company money, so you've got to pay a little bit higher rate. Subrogation. What that means is we paid the claim, the company paid the claim, but they have to go after the other company to get money back. If they get money back, that doesn't affect you. But if they don't get money back, if that person didn't have insurance or didn't have enough insurance or they just would not pay, then that's going to fall back on you, and that could raise your rates as well. Also, the thing to look at is there's two little tricks a lot of times that insurance companies will do, and they're not bad, but it's just semantics, is, when you have that accident, a lot of companies will say, well, we won't charge you for that first accident. And they may not, but a lot of companies have a zero claim discount. So you're getting that discount up front because you haven't had any claims. But if you have an accident and now you lose that discount, the effect is the same. A discount loss raises your premium. A surcharge for having an accident raises your premium. Either way, it went up. The same thing for good payer discounts. Most insurance companies have that, and they give it to you up front. If you stay a good payer, you get to keep that discount. If you're not a good payer, you have late pays, basically multiple late pays, or bounce checks, then you're going to lose that discount. So again, your rate could go up for that as well. Lastly, it doesn't matter where I work or what I do. My insurance is not going to give me any credit for that. It depends on where you go. Companies like Alpha, we give you a discount for being a teacher, a preacher, a first responder, a federal employee, or active military. So there's a lot of discounts that you can get by going to the right company. So guys, I hope this helps as you try to navigate and figure out why insurance costs what it does. I want to make sure that you've got my contact information. So you can call me at 205-919-7903. You can email me, or you can go to my website and get an auto quote. So I appreciate your time. I hope this has been helpful. Call me if you have any questions. Be careful, be safe.